Good afternoon and welcome to our last quarterly pricing webinar of the year, where I'll be looking at motor and home insurance prices over the past quarter and going back a little bit further and thinking about what we can expect for the rest of the year. If you have any questions, please log them in the chat as we go through, and I will attempt to answer as many as I can if we have time at the end. So it's a quick update, so it should only be half an hour. And to start with, I'll give you a little bit of background. So Pearson Ham, we are pricing consultants, and our mission is to help our clients succeed through better pricing. And we do that in several ways across multiple industries, from capability development to pricing strategy to price optimization and market price tracking and insights. And that's what we'll be looking at here today for UK general insurance. A little bit about the methodology, and it's quite important because there are a number of weird and wonderful pricing rules which are in use in the UK general insurance, and you have to be aware of those in order to increase the accuracy of the data that's being collected, and that goes from the data collection itself, so the methodology in terms of quote running and price collection, and the data cleansing that happens afterwards. So there are, as I said, there are a lot of rules in place which could result in prices looking as though they move in one direction, where actually they're moving in the opposite direction. So as well as the methodology we have in place to improve the accuracy of the data that we collect, we also validate with our clients to make sure that we are reporting actual price movements rather than price changes that could be impacted by the process itself. We cover a range of insurance sectors: car insurance, home, van, pet, and travel. So if you're interested in any of those, then please do get in touch and we'll be able to provide some more information on that. And in terms of accuracy, we always use real people. So it's genuine consumers who we've recruited, and they've given us permission to run their details through the Big Four price comparison sites. We also have arrangements in place with them, enabling us to do it. So there is always consent. We're not breaching any terms of use of websites, and we're always using genuine customer profiles. So there are several things that can go wrong if you were not to take that approach. So let's firstly start off with motor insurance and have a look at what's been happening here over the past 3 months. So as we can see, prices have been falling, and I'm sure this is something which we've all been experiencing in our own day-to-day working lives. So we can see each month consistently prices have dropped down, resulting in a quarterly movement of 4.4% from Q through into Q3. This continues the trend that we saw in Q2. So prices came down about 5% in Q2, and they've come down again at 4.4% in Q3, which means over the course of the past 6 months, motor insurance premiums have actually dropped by almost 10%. So we're seeing downward price movements of 9.6%, and this is for the most competitive quotes on the price comparison website. So it's an average of the top 5 prices that are quoted for a representative batch of consumers. So it's like for like consumers. We're using the same profiles. So the price movements that we're observing here, the percentage price movements, are for the same individuals with the same risk details. They're all comparable quotes. So these are our price changes that have happened in the market. Over the course of the past year, so looking at a 12-month view, we can see that prices are now lower than they were 12 months ago. So this is the first quarter that we've seen year-on-year price deflation. So prices in September this year were around 8.5% lower than they were in the same month last year. So the chart here, we can see the monthly movements in the blue bars, and the brown line is an index to September 2023. So we can see that movement of 8.5% down, and most of that happening obviously in the last 6 months, where we're seeing bigger price reductions. Having a look at a bit of a segmented view, we can see actually it's relatively consistent. So this is driver age, and there are some differences in the magnitude of change, but the direction is consistent here. So we can see that bigger year-on-year reductions are being experienced for middle-aged drivers, so a 9.5% drop for drivers between 40 and 50, and lower reductions for the younger drivers. So we can see those under 26 prices dropping by 6% year-on-year. So directionally, a lot of consistency across different segments, but the magnitude of change varying slightly depending on who the customer is here. If we look back a little bit further, so over the past 2 years, prices are still higher, so 33.4% higher for the average of the top 5 than they were the same time in 2022. So going back to September 22, and we can see that there's been a lot of premium inflation throughout 22 and 23, and it's not quite kind of dropped back down again to where it was this year. So I think that there's probably a little bit of kind of leeway there for insurers to be able to become more competitive, given the premium increases that were observed for the previous couple of years. And going back a little bit further, so this is a favorite of mine, going back to pre-COVID, beginning of 2020, we can see the kind of distinct pricing periods. So COVID, prices reducing from kind of Q2 2020 right through until the JIP impact in January 22. A bit of premium calibration following that, and then because of the increasing costs, premium inflation kicking in. So that there are a lot of reasons behind this, from cost of parts, labor shortages, kind of raw materials shortages, microchips, cost of secondhand cars increasing. So there's a lot of things coming together to drive up costs for insurers, and that's been reflected in the premium increases that we saw during that period. And then we've seen this year quite a different picture, where competition is intensifying, prices are coming down, and that's been a consistent picture. And certainly for the past 6 months, we've seen a lot more price reductions than we did earlier in the year, and certainly not since pre-2022. So some big shifts in terms of prices over the past quarter, over the past couple of quarters, as competition intensifies. And we are hearing from our clients that things are tough. It's a tough market. Competition is increasing. It's difficult to drive new business. Looking at some of the individual providers, so this is a selection of 10 of the large insurer or providers. So some of these will be brokers as well. And it shows actually that there's less consistency than we saw in Q2. So we are seeing some of those large providers starting to increase rates now. So there are some big reductions. We can see the 7%ers down on the left-hand side of the chart here, but also some smaller increases starting to flow through now. So it may be actually some insurers are finding it difficult to compete in the market. It may not be sustainable to continue to put those price cuts through, whereas others are able to continue to do that. This chart shows a 12-month trended view where we're seeing the largest year-on-year price reductions. So we can see down here the kind of the orange bar where there's a 15% drop on last year, up to a couple of percent drop at the grey one. So the grey line in the middle shows the beginning of year-on-year positives and negatives. So what we're seeing here, where most of the kind of the big price cuts have happened in the past 6 months. So obviously this is reflected in the movement of the most competitive prices, and we can see that's been driven by some of these providers. For those with kind of flat or even kind of year-on-year kind of or quarterly increases, we did see some price reductions earlier in the year. So with the others, they may have been slightly flatter, but dropped more significantly in the past couple of quarters. We've seen some of these providers go a bit earlier and then flatten out and kind of pull back a bit. So it may be actually they've done enough to get into the competitive position that they need to be in or they want to be in. And now they're able to start to kind of pull back a bit and even kind of increase premiums slightly, given the context of the market that they're in. So we will see how that progresses as we move into the final quarter of the year. So let's have a look at home insurance now. So we'll start with combined buildings and contents cover. So it's a different picture in home than we're seeing in motor. So Q3, we're seeing a price increase of just over 0.5%, so 0.6% up on the previous quarter. So although prices are increasing, it's certainly a lot lower than it has been over the past couple of years. We've seen significant price increases coming through each quarter, and that seems to have died down a bit, and there's been some stabilization. So as we look back over the past 6 months, we can see some of those big increases or bigger increases at the beginning of this period in April into May and June, and then over the past 3 months, actually July, prices dropped. August kind of relatively stable. So it's been a kind of up and down, but mostly kind of it moving up, but slowing down. So we're seeing a bit more stabilization in home following significant price increases over the past couple of years. The 12-month view clearly shows this, so we can see how that premium inflation has slowed down. Prices now around 22.5% higher than the same time last year. So this is September index back to September 2023. But it's clear to see actually that there's been a big slowdown in terms of those increases that were being put through earlier in the year. Looking back a bit further over the past 24 months, so we can see prices in combined home insurance cover now 63.3% higher than they were 2 years ago. So again, there's been significant premium inflation in home, and it's impacted by the same or similar factors that we've seen in motors. So general inflation going up, costs of repair, kind of materials, labor shortages, extended timings in terms of how long it takes for building and property to be repaired, and all of those things combining to drive up the cost of claims, and also the frequency of claims increasing as we experience more and more adverse weather events. So we're getting the storms, which bring the floods, and we're also getting intense periods of heat, which is resulting in more subsidence claims coming through as well. So we are seeing those costs actually, when we're looking at this compared with motor, it kind of makes sense that motor is able to become a bit more competitive now, whereas home, there's still some kind of uncertainty and there's still risk involved in that market. Looking at individual providers, so again, these are 10 of the larger providers within home insurance. While most have increased prices in the past quarter, and some of them very significantly, we have seen others where kind of rates have stabilized or have even dropped. So there are a few towards the left of the chart. You can see where prices this quarter are kind of more or less the same as they were in Q2. So we are seeing that slowing down, and some of those providers now able to take a more kind of flat position in terms of pricing. So they may have reached a point where actually they feel that they're in a more comfortable position. So there is the potential that we could see increasing competition in the market. Again, looking at a 12-month trended view, this is showing those providers with the lowest year-on-year increases, so going from 8% to 29%. We have seen that stabilization over the past 6 months. So in the first 6 months of this chart, then there's a lot of kind of consistency. Everyone's moving in the same direction, and then we see that plateauing, and then some kind of reductions being observed for a couple of the providers. Where we're seeing bigger year-on-year increases, there's more consistency around that kind of premium inflation. So what was happening for the providers in the first chart, in the first 6 months of this picture, has continued more or less into the last 6 months of the year. So there has been a bit of slowing down for some, but actually most of them have continued along the same route as they were previously. So again, things are kind of continuing to move upwards on home. There has been a bit of slowing down of that inflation, and we're seeing some insurers dropping rates more recently, and we'll see how that pans out. Looking at contents only now. So for the past quarter, it's been a bit up and down, but more or less prices have stayed as they were in Q2. So there was about a 0.5% increase in July, followed by some reductions in August and September. So I think that's kind of it's relatively stable. There's less consistency. It's a bit less consistent in terms of price movements. It's a bit of a smaller sample and it's a bit more erratic. So what we're seeing here is not quite aligned with combined cover, but I think it's also not subject to some of the same cost drivers. So if we're seeing general inflation settling down a bit, and that impact on the kind of the cost of replacing property from within the homes that are insured, then it's not subject to some of the same risks that would be impacting on the costs of buildings insurance. So contents only, I think, is able to kind of slow down a bit and to put some price reductions in. Looking at that over the past 12 months, so again, we can see premium inflation in the first 6, and then over the kind of past couple of quarters, things really slowing down. We've seen a couple of months of prices dropping, and so that's one to just watch to see what happens there over the past couple of years. Similar picture to combined cover, but the kind of the magnitude of premium inflation hasn't been quite the same. So price is 27% up on where they were 24 months ago. So rather than the 63% that we're seeing for combined cover, it's still kind of significant increases, and largely inflation-led. So there may be some room for some reduction there. And then looking at some of the individual providers. So again, the Q3 trend is comparable with combined cover. So we're seeing some big increases. So 11.8% there on the right-hand side of the chart, some 5%ers. And then on the left-hand side, we are seeing some plateauing. We're seeing almost a 2% quarter-on-quarter drop for one provider here. So again, it's kind of reflecting what we see on combined cover, not quite to the same extent, but kind of directionally, it's kind of very similar. So I think we may see some prices dropping in contents only before it happens in combined, but we'll wait and see. Looking at some of those individual providers trended over the past 12 months, we can see that it's kind of relatively flat. Where the year-on-year increases have been lower, things have stayed relatively flat. There's some increases earlier in the year, towards the end of last year into Q1, but things have really flattened out with some slight downward trends now evident. So if those continue, then we could see competition increasing in contents only. And then where we're seeing the bigger year-on-year increases, again, we've seen that consistency in terms of price increase. So some of those lines just continuing up at the same angle as they have been over the past 12 months. So again, similar to what's being observed on combined cover, we are seeing some differences in terms of individual provider strategies, and that may kind of flow through to the most competitive price trend as we look at the end of the year. So looking ahead, what do we expect to see? So firstly, I thought it would be interesting to do a comparison between what we're seeing in terms of quoted prices and what's publicly available from the ABI in terms of paid premium. So as we can see here, I've kind of used the figures for each of the quarters in orange, and we've got our own figures in blue, and this is indexed back to Q3 2023. That's the lines. So we can see that there is a bit of a lag in terms of the difference between quoted and paid prices. So quoted prices falling sooner and to a greater extent than paid prices, but it's kind of moving in the same direction. So that trend is there. And I think there's a couple of reasons for this. So if we think about what the difference between quoted and paid and why would they not match, well, there are people who are not shopping around, and obviously they're not going to benefit from quoted premiums dropping. So they will just continue to pay whatever's been kind of quoted to them from their existing provider. And where customers have a perceived cost of switching, so that there is a cost to customers of switching, or perceived cost in terms of effort that's needed. There's a risk involved, there's uncertainty. If that is, for example, £30 and the premium is £600, then prices have to go down by at least 5% before they're even considering moving. So I think it's clear kind of why there may be a lag between quoted and paid, and it can make sense when we think about it in this way. If there are larger costs of switching, so somebody is thinking, well, £45 is my perceived cost in terms of hassle, then again, it's 7.5% drop on a £600 premium. So they have to move, quoted prices have to move down significantly before it starts to impact on paid premiums. And if we continue this trend that we've seen, so looking at Q3, I'd expect ABI figures to show that paid premiums have come down a bit more than they did in Q2, maybe up to 5%. Prices will still year on year be higher, so ours are quoted prices are lower, but I would expect paid to remain higher. but we are seeing that trend and the lag, and I think it's interesting to look at it in this way. So we'll see when the next ABI figures come out how close I got with that. So thinking about where we are and where do we expect to be by the end of the year, I've put some kind of estimates together. So I do this each year, looking at, well, where do we expect to end? So I've got a high, low, and a medium case. So with motor, we have seen significant premium reduction this year, and we've seen that continuing through Q2 into Q3. We're seeing prices now lower than they were last year, but we are seeing that start to kind of stabilize a bit. We're seeing some price increases coming in. If we're looking at individual providers, we are seeing some big reductions, but also some increases in there as well. So it may be actually providers have reached a point where the competition is kind of less appealing and less sustainable than it may have been earlier in the year. So we might see some flattening out. We might see some premiums increasing before the end of the year, or the trend may continue in the same direction as it has been. So if we're thinking about the end of 2024, I would expect things to end the year about somewhere between 11 and 14% lower than they were at the start of the year. So I think we are seeing that level of premium reduction, and things are slowing down a bit, but time will tell. So over the next few months, we will look at, and in January, we'll update on what we see here. There's also some changes happening. So the kind of the Ogden rate change is coming up soon. So again, that may give some providers a bit more confidence in terms of cutting rates. So again, we may see that continuing to come down or flatten out. On home, again, it's been moving in the opposite direction. So prices have been coming up, and that's continued for the past couple of years. But as with motor, we're seeing the trend slow down. So we're seeing a bit of stability appearing in the home market. So it may be actually in the last quarter of the year, things slow down a bit more. Things may flatten off. Things may increase. They may continue to increase slightly, but I think not to the extent that we saw in the past couple of years. So maybe to the same as we've seen in Q2, Q3. So what we'd expect is in combined cover, something between 13 to 16% higher than last year. So price increases throughout the year coming in around that level. Contents only, it's a bit less kind of easy to kind of predict the kind of. I think we're looking at somewhere between 4 and 5% increase year on the kind of over the course of the year. So as I say, it's a bit less stable, but I think in terms of what we're seeing recently in price movements, things have slowed down and probably likely to continue somewhere around the same level as they have been. So we've got 1 or 2 minutes left. I shall have a look at the chat. So does the motor forecast make any allowance for changes in the discount rate? So yeah, I think that's in terms of what we're seeing for the kind of the premium reductions. What do we think 2025 holds for motor and home? So that's a bigger question. I don't mind having a crack at the next 3 months, but the 12 months following that, again, it's difficult to say. So we may see some more premium drop in motor given the Ogden changes. Maybe not. I think it's one of those where actually historically we haven't seen as big an impact on street prices as we might have expected from the Ogden rate. So it's a big thing, and everybody within the industry is kind of excited and interested to see what happens. But I think the kind of the market dynamics and competition and the pricing of competition has more of an impact than that in terms of what is quoted to customers. Okay, so I think that brings us to the end. If you have any questions or want any or more information from me, then please do reach out. My email is there, stephenkennedy@pearsonhamgroup.com. And if I don't hear from you, then have a good Christmas and New Year. And I shall look forward to our Q4 webinar in January 2025. Thank you and have a good day.